Good morning, ladies and gents, and welcome to the April 2026 edition of the Blackfinch 10-minute market forecast. Thank you for joining us today. My name is Jordan Kent, Distribution and Sales Exec for Blackfinch Asset Management, and I'm joined today by Assistant Portfolio Manager, Mr. Josh Clayton. Those joining us for the first time, we use this webinar to provide you with what we believe to be some of the most important headlines across the globe that are shaping markets, giving you an outline of what's happening and how our portfolio is positioned to help answer your client queries. If at any point you have any questions, be our guest and submit it using your Q&A box. Otherwise, we'll provide our contact details at the end of the webinar if you'd like to discuss it with us directly. Now, before I begin, it's important for me to note that the details we cover in today's session are intended for financial professionals only, and therefore shouldn't be interpreted or taken as financial advice. Now, this morning, we have three themes to cover for you. First up is how the geopolitical landscape is driving the oil market. Second are the challenges that central banks are facing when it comes to growth against inflation. And finally, the shift we've seen recently in US politics. And so I'll now hand things over to Josh to cover the detail of today's forecast. Morning, Josh.
Morning, Jordan. Good morning, everyone. A slight caveat on today. I might slightly go over the 10-minute deadline, so please do stay with us. So we're a month on from the conflict now. We've seen both markets and the oil price whipsaw back and forth off the back of Trump's claims on progress before Iran quickly refuting them. And this weekend's events is no more case in point, especially with the focus on the Strait of Hormuz. And while this all drags on, there's this growing risk of a more severe supply side shock as the conflict goes into its second month. Now, we've unfortunately seen things escalate from our last webinar, and more recently, we've had an Iran-backed militant group named Hezbollah, as well as a similar Iran-backed movement in Yemen named the Houthis also joined the conflict. An escalation with the Houthis risks a similar shipping disruption through the Bab el-Mandab Strait that connects the Red Sea to the rest of the oceans because of Yemen's proximity to the shipping lane. So very much further pressure on oil supply for the moment. But if you didn't know, this issue over oil originally wasn't about there not being enough supply in the world. In fact, when we came into the year, one of the big themes was the oversupply of energy and that OPEC wanted to produce more oil but not drive down its price. So there's certainly no issue on capacity. It's just getting it out of this strait. Europe, more specifically, has its own challenges. It's not just petrol; it's gas that needs to be factored in as well. And as I said in the previous webinar, I mentioned that this commodity is typically the first place markets react during geopolitical events. And I want to bring in this chart here. So we're looking at the historical price of a barrel of Brent crude oil over nearly 35 to 40 years, all the way up to recent pricing. And that red dashed box or boxes mark key conflicts over the period. And we've seen the sharp move higher from around $70 to well over $100 per barrel toward the end of March. But if we just look with a long-term lens at the chart, there's quite a usual pattern. And what the data tells us historically is that these geopolitical events tend to create this sharp spike in the price of oil, but they're typically short-lived. And I think that's largely because oil is ultimately driven by supply and demand fundamentals. Even in past events like the Iran sanctions in 2012, your prices move quickly higher, but reverse once supply adjusts and then your demand softens. And importantly, markets are very much signaling this today still, even with the escalation of events. And the oil future curve, which is a futures curve which is heavily backwardated, which basically means the current price of oil is higher than prices for delivery in the future. Again, that implies that things shouldn't stay this way for long. But while this move certainly feels significant, history would suggest this is more of a short-term shock than a structural shift. But I think, as always, we've got to be humble when making these forecasts. Things can just shift incredibly quickly day on day. So let's just see how this develops from here. I think that then brings us on to central banks. This has been one of the key questions. Is this going to feed into an oil shock and give us a broader inflation problem like we saw in 2022? So there's a few comments here. First things first, we're seeing this go on in markets at the moment. They are telling us that inflation's on its way up. We absolutely know this is going to happen because we're seeing this when we go to the pump, right? And we're looking at a price of petrol. I think I paid 153 on the weekend for unleaded. My dad said he paid 191 for diesel. And that just means headline inflation will likely be above 3% numbers globally. Sadly for us, it's more like north of 4%, as we're starting from 3 now. So inflation's up, therefore markets are thinking central banks have to hike interest rates. And we've been seeing this dramatic swings in pricing for central banks. I think the Bank of England was forecast to cut interest rates twice by the end of the year, and then it priced for it to hike twice. And this is the big dilemma for central banks. And I was kind of thinking, are they really going to start hiking interest rates? And I think this is where the table comes in. Feel free to reach out after, we can send you the slides. But just to summarize, this is not 2022 where your headline inflation goes up. Central banks really move the goalpost in terms of interest rates by this huge amount. And there's a few reasons as to why. So, first, they were starting from zero interest rates or even negative back then. So they had to normalize first, get it back to the neutral interest rate level, let alone meaningfully put their foot on the brake further after that. So that's quite important. The second part is that inflation, it was already very different back then, even before this energy shock from Ukraine and Russia. We had all of the pandemic related supply chain inflation that was hitting the global economy in 2022. So it was already high. You can see it on the left hand side of the table there. And then the other thing that was very different was labour markets. They were really hot, like absolutely on fire, because their economies were reopening, companies were scrambling over themselves to rehire people, and that gave them a lot of pricing power. And that's what typically central banks call second round effects. And I think that's one of the key takeaways here. What one of the worries is if headline inflation goes up, and naturally workers go to their boss, they're going to ask for a big pay rise, rightfully so. But if the boss says yes, that then has knock-on effects. The company's energy costs could go up, wage costs have certainly increased. So they're going to raise prices to match that, and that creates this wage price spiral. And although these figures in charts that we're seeing aren't dramatically different, I think it's very much in the detail. The other thing that is quite different, and I think is quite unlikely, is that governments are going to give these massive fiscal packages like they did in the pandemic. Think about your furlough in the UK, your stimmy checks in the US. These are two very different scenarios. Maybe Trump could throw a bone because of the midterms coming up. I think it's very difficult to see in Europe at the moment. So for those reasons, it certainly doesn't feel like central banks are going to be in a rush to raise interest rates. It could be that they're going to absorb the shocks where they can, and that's our stance here with the investment team, is that major central banks are going to do exactly that, right? They're going to hold on as best they can for as long as they can, unless this conflict materially steps up again and changes the scenario. So I think just take away those points as some reassurance for your clients. This is not a repeat of 2022. So the final thing to highlight is politics. It's already this key driver in markets. It's very much coming into focus now. This US-Israel war with Iran is entered into its second month, and Trump is certainly looking for an off-ramp, right? We're seeing it today with the deadline. And I think this chart on the screen could be one of the reasons as to why. What we're looking at here, odds from a company called Polymarket. They are the world's largest prediction market platform where users trade shares using crypto to bet on the outcomes of real-world events. And this is completely decentralized, so please do take this with a pinch of salt, but it's a good tool to get your finger on the pulse on the topic very quickly. And we can see straight away from the chart, this war is just unpopular from Americans at a time where these midterm elections are looming. The Republicans lost the Florida state seat that was home to Trump's Mar-a-Lago estate. The Democrats have flipped 29 legislative seats during Trump's second presidency compared to zero for the Republicans. And I'm speculating here, but Trump could even face impeachment if the House is lost, or could even raise conviction if the Democrats take Senate. So although this feels like a very long way away, the canvassing, so the actual process starts in the summer months, and time is pressing on. Things are ramping up, and there's a very strong relationship between the oil price and consumer sentiment in the US. And the sentiment was already low, but that's really started to hit his approval rating. And let's not forget that a big part of his campaign was to bring the cost of living down, and now we've hit, or they've hit, $4 per barrel of gasoline in the US. So a very challenging number for any household there. And a big part of our bullish investment thesis for this year was the One Big Beautiful Bill Act and the tax rates that were coming about now. And I saw some stats on this, and in fact, for the lower income household, the rise in gasoline almost entirely wipes out the benefit that they would have got from those tax rebates. So it does feel more problematic. The longer this continues, the longer this carries on, it creates even more incentive for the president to find this off ramp to get this done or get some kind of resolution. And I think that's where markets have really started to panic over the last few weeks is even if the US wants to de-escalate, maybe Pandora's box is already opened and it's just out of Trump's hands. And Iran certainly wants to keep this conflict going for as long as possible. They want to demonstrate their ability to create economic pain or trouble, and all in the hope that this is going to deter future attacks coming. So to summarize, while markets are reacting to these short-term events as they unfold, let's try to do our best to keep a long-term lens on to see that a lot of the time these shocks can be temporary. Second, the macro backdrop today is in fact more stable than in previous cycles, certainly like 2022 from a policy perspective as well. And while political dynamics are shifting, this is something to monitor rather than to immediately react to. From a portfolio perspective, there's no change in our stance from the previous month's webinar at this stage, which is remaining very well diversified, maintaining our conviction, and we want these positions to play out rather than avoiding short-term knee-jerk reactions. And importantly, despite all of this recent volatility, our portfolios have held up relatively well. They remain broadly in line with where we started this year off. So certainly one to mention to your clients that this drawdown has in fact come off the back of some very strong gains in the first couple of months. So yeah, please do take that away. And Jordan, that's everything from me. So I'll pass back to you for the wrap up. Thank you, everyone.
Thank you very much, Josh, and thank you folks for choosing to spend your morning with us. As promised, if you do have any questions, you can contact Josh and I directly using the details on screen for you now, whether it's about the content we've covered today, perhaps any topics we haven't covered, or if you want to hear more about our range of managed and tailored portfolio services, we'd love to hear from you. And so that does conclude today's session, and we hope you'll join us for the next instalment, which will take place on the 5th of May at the same time of 8:50. But for now, on behalf of all of us here at Blackfinch Group, I'd like to wish you all a very pleasant day, and we look forward to speaking with you again very soon. Bye for now.